Okay, let's work on some questions at the end of this reading. I find that the questions here dig into tiny little detail that sits outside of the learning objective. So if you were frustrated by these questions as to where in the reading was this, some of the answers to the questions are buried deep within exhibits. So I don't know what to tell you on this. Which of the following is most likely to participate in early stage financing? And we do have an exhibit that was presented in terms of the types of investors in the stage. Founders and angel investors tend to hang out around pre-seed and seed. Strategic investors, there they are right here in early stage, and we are asking about early stage. Private equity funds are most likely to use, and we're given three options: leverage buyouts, option-based strategies, and merger arbitrage strategies. We haven't seen based on the order of the modules, you haven't seen the hedge fund module yet, so you wouldn't recognize these as being hedge fund strategies, but they are. Only A is a private equity strategy. A shared advantage of IPO and SPAC exit strategies for a private equity fund is there. A, fast and simple execution. Well, we can see for the IPO that is just not so. We can eliminate that. Ability to win market attention. So where do we have here? Notoriety to private equity sponsor and involvement of high-profile seasoned sponsors and their investor networks. That is a characteristic shared by both. Transaction structure flexibility only with the SPAC. The IPO is very standardized in the steps that you have to go through. So we can get rid of that one. B. Which of the following combinations of financial characteristics most likely would be associated with venture debt transaction? And I've given you the reference from the reading. Venture debt is private debt funding that provides venture capital backing to startup or early stage companies that may be generating little or negative cash flow. And there we are here. Declining revenues and cash flow. This would either be turnaround or perhaps even distressed debt and positive revenues and cash flow. This is a mature company. In contrast to direct lending and distressed debt, mezzanine debt most likely requires higher interest rates for its investors due to we have reliance on leverage, we have overall ranking and status in company debt structure, and need for management involvement over an extended period of time. That is a characteristic of distressed debt. From the reading, the reference here, mezzanine debt refers to private credit subordinated to senior secured debt but senior to equity. Because of its typically junior ranking and its usually unsecured status, mezzanine debt is riskier than senior secured debt. That's not saying much. Any debt that is not senior secured is riskier than senior secured. So I don't know that we're really testing much here by saying that. But B. Okay, this is a flawed question on so many levels. And let me see if I can demonstrate to you why it's flawed. The question asks a feature that private debt and public debt share in the setting of their investment returns is there, and it gives you three answers: relationship to benchmark interest rates, which is from the CFAI, the correct answer. However, if it said their investment rates to set the rate on the debt, yes, because all debt is the risk-free rate plus some credit premium plus some maturity premium plus some liquidity premium. All debt is built up that way. So it's not so much that it's a feature of private and public debt that they share. It's all debt shares that. But they said their investment return, that's the return you get. Private debt can default, public debt can pay off. We would not then say, they share a relationship. The return shares a relationship to the benchmark interest rate. The investment rate, the rate at which they put the debt out, both share a relationship to benchmark interest rates, but the return will be what the return will be. If you lend money to a lender and the lender defaults, their default is not related to the risk-free rate or to benchmark interest rates. So I think they should have said their investment yields or their investment rates, but not their investment returns. Need for specialized investment knowledge. Well, you do need that for private debt, but if you're investing in public distressed debt, triple C, let's say, or you're just investing in high yield as a category, you're telling me you don't need specialized investment knowledge for investing in publicly traded distressed debt? They share that. The question is not clear on under what conditions you're comparing the two. So you could say, well, it's B as well. It's not saying most likely, right? It's not saying most likely. An opportunity for illiquidity premiums. Now, if you ended there, you would definitely say, okay, there's private debt, but it's in market crises. Well, in market crises, everything goes illiquid. Everything goes illiquid. So if you were if you were in a market crisis and you wanted to buy publicly traded debt, it would be trading with a significant illiquidity premium. So all of these answers are correct. However, I think the author was trying to make a linear argument from this line here. Investors in private debt could realize higher returns from the illiquidity premium. And there it is. So sure, you can get higher from the illiquidity premium. But this question says in market crises. It says private lending funds fill the financing gap left by traditional lenders following 2008 financial crisis. Yeah, okay, they step in. If public markets are unwilling to lend money, private companies step in and they'll realize an illiquidity premium. But this is saying in market crises. You see, my dilemma here is that we're talking about returns. We're talking about something here that's common to all debt, not just the difference between the two. You need specialized knowledge for triple C, and you get illiquidity premiums in market crises in all debt except the most highly rated government debt. Yeah. The most likely effect on a portfolio's diversification when exposure to direct lending commences is that it. I don't think you can answer this question. We're looking at portfolio diversification in direct lending. So in other words, you have the portfolio that is simply going to make a loan. That is direct. Much like direct investing in real estate means you're not going to invest in a fund that buys real estate. You're simply going to buy the real estate. Well, what is the size of this portfolio? Right? If you're a $10 million portfolio, you're probably not getting involved in direct lending. You are going to be of a certain size before you get involved in direct lending. So if you are a pension fund or an endowment or a foundation or a sovereign wealth fund and you decide to put 5% of your available assets into direct lending, you could actually increase diversification. I don't know, unless you give me some baseline to work from, how do I know whether it decreases, remains the same, or increases? Now it's saying most likely effect. But I have to think that if you're getting involved in direct lending, you are of a certain size that it makes sense, first of all. And if you are of a certain size that it makes sense, it does not follow that the most likely effect is that portfolio diversification decreases. Because if that were true, very few sophisticated funds would ever get involved in direct lending, because if you decrease diversification, you increase risk. So it doesn't follow, and I'm sorry, but it's a flawed question. Private equity funds whose vintage year occurs in the expanding phase of the business cycle tend to earn excess returns by investing in companies that are, and we do have this reference from the reading here, funds seeded during the expanding phase of the business cycle tend to earn excess returns if they fund early stage companies. Okay, this question tests a very minute detail given as an example in an exhibit. And to me, it seems like it's way outside the learning objective and rather an unfair question. The private capital category most likely to offer the highest diversification benefit for portfolios holding public stock and bonds is private debt, private equity, or venture capital. And we are given correlations for a particular index in terms of its private equity, its venture, its buyout, and private debt categories. And the lowest correlation would have the highest diversification benefits, which is venture. Again, a small, tiny little detail from a corner of the reading that I think is rather unfair as a question.